Welcome to the latest tax update for professionals webinar. So today we'll be looking at the mini budget and also the fallout coming out from that over the last week or so, as well as the usual roundup of other topical tax issues. Just to let you know, the webinar is being recorded and will be uploaded to our website shortly after we finish, which should be no later than 3 o'clock today. Please use the question functionality in Zoom to ask anything as we go along. But if you don't mind, we'll pick those questions up at the end and deal with them then in one go. So today we've got myself, Vicky, and Paul, and we're going to talk about corporation tax and business taxes, private client matters, and tax dispute and resolution issues, respectively. So I'll be picking up corporation tax and business taxes, Vicky private client as usual, and Paul finishing off with all the interesting stuff around tax dispute and resolution. So let's kick off then with corporation tax and business taxes. So the mini budget, well, I think beforehand, everybody was expecting this to be a relatively low-key announcement from a tax perspective. It was well trailed in advance that we're going to get the reduction in the 1.25% NI and also the corporation tax reduction as well. But clearly there were other major announcements made, and then subsequent U-turns or changes in direction, as I think one MP called it yesterday. But nevertheless, it was one of the most impactful budgets, budget stroke mini budget stroke emergency budget stroke fiscal statements that we've had in a number of years. Plenty to talk about. So starting off looking at corporation tax and business taxes. And as expected, we're not now going to get the increase in corporation tax from the 1st of April 2023. So we are going to have just a single rate of 19% now and thereafter. One of the changes that was supposed to come in next April was around how quarterly installment payments are calculated in terms of the associated companies regime. So currently, when you're looking at quarterly installment payments and that 1.5 million profit figure, which is the trigger for going into the regime, you divide that 1.5 million by the number of group companies. You don't look at companies under common control. Now, when the 25% rate was legislated for last year, what also changed was that for quarterly installment payments, the definition was going to be broader in terms of the associated companies to bring in companies under common control. Now, like I say, in terms of the announcement that was made and the rather limited information that accompanied the announcement, it was silent on that point. So we don't know for sure yet whether we are still in the current, we're going to stick with the current regime, i.e. you're just looking at group companies, or we are indeed going to move to a situation where you include associated companies. There's an element of watch this space on that, because clearly it could have some quite wide-ranging ramifications when we have lots of companies under common control, but not within a group. Another impact of the decision not to increase the corporation tax rate is around the super deduction. So this is the enhanced capital allowances that were introduced, whereby you get this 130% first year allowance. But the quid pro quo of that is that when you come to sell the asset, you get a balancing charge arising based upon the proceeds that are received. Now, the broad idea behind the super deduction was that 130% allowance with a tax rate of 19% came to about 25%. It was 24.7%. And so the logic is that when you get the balancing charge in the future, once the new rate went up to 25%, it'll be taxed at that particular rate. So it was only a timing difference. Now, of course, in the future, that corporation tax rate is only going to be 19%. And the way the calculation works is you apply a multiplier to the disposal proceeds to work out what comes back into tax. And that multiplier is set at 1 for periods commencing after 1st of April 23. Again, that was on the basis that we'd have a corporation tax rate of 25%. So if the multiplier is still 1 now, there could be an absolute saving here rather than a timing difference, because if the balancing charge, you've had relief at nearly 25%, but the balancing charge potentially is only going to be taxed at 19%. Now, the only note of caution around this was there was some wording in the growth plan that accompanied this statement on the 23rd, and that referred to the requirement to amend some of the technical provisions relating to the super deduction to ensure that the relief continues to operate as intended. So that may mean that they have thought about this, and there will be a recognition that actually when it comes to that balancing charge arising, that could be taxed at the equivalent rate at which the tax relief was originally given on the expenditure. So just a point of note there, and something I'm sure which will become clearer once we get draft legislation and the finance bill is published, etc. Sticking with the capital allowances theme, what was announced, and this is welcome, I think, is that the annual investment allowance at £1 million is now permanent. Now, I'll put a bit of a question mark there because, as we all know, the annual investment allowance has been a bit of a roller coaster over the last 10, maybe more years. You know, it seems to have gone up and down on almost an annual basis. So hopefully this will be here to stay, at least for the foreseeable future. It was due to reduce to £200,000 from next April. So at £1 million AIA, that should cover most qualifying expenditure for the majority of of companies and businesses. So it is a welcome change. That now, there wasn't any note around whether the super deduction was going to be continued. It looks like it isn't. It was silent on the point, which leads me to suspect that that's it now as far as the super deduction is concerned. But I guess with the AIAs being maintained as £1 million, it may be thought that that's generous enough in terms of a capital allowance position going forward, because that will cover the majority of expenditure for the majority of companies. Okay, now moving on to personal tax, and this is when it gets really annoying when a change is made to announcements sort of 24 hours before you're about to do a presentation on it. So lots of lines on this slide because, of course, the change in the top rate tax of 45% in terms of removing it altogether, that's now been reversed. So it is still in place. I mean, clearly, politically, it was a very controversial decision to make, even though from a fiscal perspective and a borrowing point of view, that 45% rate didn't actually, in the scheme of things, or doesn't change the landscape considerably in terms of the borrowing that's going to be required as a result of the mini budget. So we are as we were as far as higher rate tax is concerned. We've still got the 45%, and the higher rate for dividends is still in play. And what we do have is the removal of the 1.25% NI increase, and that's reversing from the 6th of November this year. I mean, the question there is around to what extent payroll software will be updated in time to accommodate that, and if it's not able to do it for the payroll run for that particular period, what is then the mechanism for making sure that that reduction is reflected in future payrolls? So again, something for the software developers to give them a bit of a headache there in terms of dealing with it. Because we've got a mid-year change in NI rates, what it does mean is that we're going to have a blended rate for the current tax year for Class 1A and Class 1B national insurance contributions. So Class 1A are your contributions on benefits in kind, and Class 1B are the contributions associated with PAYE settlement agreements. So that blended rate is 14.53%. Also, because directors are paid, or rather, NI is assessed on directors on an annual basis, we've also got a blended rate for directors' remuneration as well. 12.73 up to the upper earnings limit and 2.73 thereafter. What also changes, the health and social care levy is being scrapped as part and parcel of these proceeds, and so this was a they call it a hypothecated tax, i.e., it was earmarked. The funds being raised from it were earmarked for a particular area, and in this case, social care. Now that funding that was earmarked is now going to come apparently from general taxation. Now, the additional rabbit out of the hat that was pulled as part of the announcement was that the basic rate of tax is being reduced to 19% from 6th of April 2023. Okay, moving away from sort of the major taxes as such, some other announcements which are very important and very relevant for a lot of businesses. First of all, around looking at off-payroll working. So this is it's a welcome relaxation to the off-payroll working rules. It was clearly an administrative burden on those businesses who fell within the requirements, because they had to assess the employment status of contractors they were engaging. And if you recall, these new rules were brought in 2017 for the public sector and 2021 for the private sector. And anecdotally, what it seems to have led to was a lot of contractors essentially being put on payroll because the risk of getting it wrong fell on the engager rather than on the personal service company. And so the engager would take the most prudent route in a lot of cases, and therefore subject those payments to the contractors, subject them to PAYE and NIC as though they were inside IR35. Now, what's happening from the 6th of April next year, we're going back to the old rules. So that means that it's the personal service company which is to determine the employment status. So the risk falls back on the PSC. But remember, the current rules around the engager having to make that decision, they are still in place until next April. Now, again, this potentially is going to cause a bit of an issue, particularly where, like I mentioned, a lot of contractors, they've received the status determination statements in the past which have determined they're inside IR35, I suspect it's now going to be difficult for those same contractors working under the same contract to argue a different position from April 2023. So it may be a case of waiting till a new contract is entered into and then reviewing the situation. So that is something that will cause a bit of fallout, I suspect, from this change, albeit being a welcome change in general. Some of the other kind of sundry matters coming out. Company share option plans. The limit in terms of the value of the shares at date of grant has doubled, or will be doubled from next April to £60,000 from £30,000. Now, you don't, we certainly don't come across the CSOP arrangements very often, because enterprise management incentives are the usual kind of go-to share option scheme for SME businesses. But CSOPs are used where either the company doesn't qualify for EMI because it doesn't undertake a qualifying trade, so say a property investment company, for example, or it's too large. So if it has more than 250 employees, you can't do an EMI in those companies. So that's when CSOPs are often used. The seed enterprise investment scheme has become more attractive. So whilst the tax relief is still the same, so you get a 50% upfront income tax deduction based on the amount of the investment, and also CGT deferral and exemption on certain investments. The relief is limited to smaller companies. And so from April next year, the companies can raise up to £250,000 under SEIS, increasing from £150,000. The amount an individual can claim tax relief on in any one tax year is doubled to £200,000 from £100,000. And the gross assets limit, this is the a test put on the company in terms of whether it can qualify for raising SEIS funds. That's increased to £350,000 from £200,000, again from next April. And finally, the age limit of companies. So the trade or the company used to have to be less than 2 years old in order to qualify for SEIS. That's been increased now to 3 years. Some changes on SDLT. The 0% ban for residential property has been increased to £250,000. Remember, we do still have the 3% surcharge for second properties and companies. And the first-time buyer threshold has increased to 425 from 300. And also the maximum value of the property that can be acquired, it's gone up to 625 from £500,000. Some new investment zones were announced, or potential new zones were announced. I think there's 38 areas that have expressed an interest. And the idea being here is that investment into these zones will attract various tax reliefs. So business rates relief, 0% SDLT, structures and buildings allowances at 20% rather than 3%. And this is caused a bit of consternation from perhaps the most unlikely of sources. The Royal Society for the Protection of Birds have been up in arms about this, and I suspect you know you're in trouble when you radicalise the RSPB. But we'll see how those zones progress. And finally, on the mini budget, I just wanted to mention that the Office for Tax Simplification is going to be closed down. The Treasury and HMRC are now going to be responsible for that mandate of making tax more straightforward in terms of the legislation. I think the OTS did a lot of good work over the last few years in trying to simplify what is, we all know, very complex tax code. So hopefully HM Treasury and the Revenue can continue that work. I just wanted to touch on a couple of non-budget points, but a couple of points which are really very relevant in terms of things that are topical. One is around a company purchase of own shares point when you're using multiple completion contracts. As you may be aware, when you're looking at a company purchase of own shares, under company law, you have to undertake the transaction in one go, and the consideration has to be fully paid for in cash. So this makes it difficult where you want to do the transaction on a deferred basis, either because there's not sufficient cash to do that, or maybe insufficient reserves to be able to do it. If the money is lent back from the vendor to the company, very often you'll fall foul of what's called the connection test. So you can't have more than 30% of the share capital or loan capital after a buyback has taken place. So these factors all made doing purchase of own shares on deferred terms difficult. One way around that was to use what's called a multiple completion contract. So the way this typically worked was that the vendor gave up beneficial ownership in those shares on day one, and so at that time satisfied those various conditions, but the completions took place over a period of time, as if it was a deferred contract. And that all worked perfectly fine. The revenue gave clearances for those sorts of transactions. Sometimes they needed a little nudge in terms of explaining to them why they worked, but everybody was happy until now. So HMRC have provided an update on their view on the tax treatment of multiple completion contracts. And this is all around the issue of legal and beneficial ownership of shares. Because for tax purposes, it's the beneficial ownership which is the key point. It's the beneficial owner of the shares who has the tax liability, etc. And the previous position, like I said, based on the beneficial ownership, so long as you retain shares in which you lost that beneficial ownership, then you could still satisfy the connection tests, even though you still legally own some of the shares. HMRC's new position is that it's the legal ownership which is important, rather than the beneficial ownership. And clearly that turns things on its head. So therefore, what we would normally have done is, at the time of the purchase of own shares, we'd have just changed the rights to the remaining shares, the shares which can be bought back later, so they had no interest at all in the company. But if they're still legally owned now, we have to take them into account. Now, HMRC say that it's all around this word possesses, and it refers to legal rather than beneficial ownership. Now, what the Revenue have said, that any previous clearances that they've issued for multiple completion contracts will remain valid. So if you've done this in the past, or you've recently had a clearance granted from the Revenue, then that's perfectly fine. But they'll be adopting this new basis for any clearances going forward. And they will be updating their guidance in due course. So this means we would now need to look at alternatives when we're thinking about doing a buyback of shares on a deferred basis. And the usual alternative here is to go down what we call the NewCo route. So instead of the company buying back its shares, we put a new company on top of the existing company. Some of the shareholders maybe do a share-for-share exchange, but the exiting shareholder would sell their shares in the existing company for a combination of upfront cash, deferred cash, which could be in the form of loan notes, for example, and maybe still some equity in the new co. So it's a different way of achieving the same end result. Obviously, you end up with a group structure at the end of that, which you wouldn't do with a purchase of own shares. So a little bit more cumbersome, I guess, from an admin perspective. But there are ways around this. But in essence, if we're going to go down the route of using a multiple completion contract, we need to make sure that the connection test is met when looking at legal ownership now, rather than beneficial ownership. Is HMRC right? Well, who knows? I think there are a lot of legal commentators who think they're incorrect in terms of their opinion on this, and clearly this is just HMRC's view, but it's whether you'd want to take a case to tribunal, or indeed whether the revenue would want to take a case to tribunal to accept this point. As there is an alternative there in using a new code structure, it may be worth, or rather it's probably not worth the hassle of trying to argue the point with HMRC. Just want to touch on the construction industry scheme and property investment companies. Again, just something that's becoming more common, I think, in terms of us coming across this. So don't forget that property investment companies can be within the CIS in certain circumstances. Now, property developers are mainstream contractors. You know, if they're creating new buildings, renovating and converting existing buildings, over several engineering works, they are automatically in CIS. You know, no doubt about it. But with property investors, they're not necessarily involved in the construction of buildings, but they can still be what's called a deemed contractor for CIS purposes. And the deemed contractor is one whose cumulative expenditure on construction operations exceeds 3 million in a previous 12-month period. So it's quite a high bar to satisfy, but it's one that can sometimes be overlooked. You also need a bit more care if you've got a property investor who also engages in property development. Because as soon as you cross that line to property development, the question to be asked then is, are they now a mainstream contractor, and therefore that £3 million de minimis no longer applies? Just another point to mention about property investors or any business actually, and it's not on the slide, but something that's I've come across very recently, is around when a landlord makes a contribution to a tenant's fit-out costs. Now, in those circumstances, the tenant could be classed as a subcontractor, and so the landlord may have to withhold CIS tax, 20 or 30%, from the payment they make to the tenant, and so that could cause a bit of a cash flow issue potentially. And it's difficult for tenants to get gross status from HMRC for CIS purposes if they haven't had a history in construction. So landlord contributions is just something to think about, or rather think about CIS when you're looking at landlord contributions in terms of whether they are applicable or not. And finally, just want to finish off on MTD for income tax. Don't forget, I mean, there's lots of stuff around this now, but it's getting closer and closer. From the 6th of April 24, MTD for income tax comes in. We do have a transitional year in 2023-24. Sole traders and landlords initially, partnerships have another year's grace until 6th of April 25. But we do need to start thinking about the position now for unincorporated businesses. Do we move the accounting period to a tax year end, 31st of March or 5th of April in 2022-23? There's loads of variables to consider here. Every business will be different depending upon what profits they're making, their position on overlap relief, etc. But again, it's just something that should be on our radars now, and it's something that I'll be talking more about in future presentations. So plenty to think about there across a whole range of issues. I'd now like to hand you over to Vicky, who is going to pick up on some private client points. Thank you, Vicky.
Thanks, Greg, and good afternoon, everybody. The main topic that I'm going to be talking about today are the tax implications of divorce, because there were some changes or proposed changes announced on the 20th of July. And these have come about from some of the work of the Office of Tax Simplification by HMRC issued a policy paper entitled Capital Gains Tax, Transfers of Assets Between Spouses and Civil Partners in the Process of Separating. And assuming that all of these aspects are enacted, these changes will take effect from the 6th of April next year, and they will remove many of the tax burdens for divorcing couples. And so they are a very welcome expansion of the current rules. You may remember that in our last professional update, I did a slot on the tax implications from divorce. So this is a good follow-up to those. So these changes should do a number of things. They should reduce the time pressure for couples who are trying to agree a fair split of their assets. They should reduce some of the unfairnesses and inconsistencies in the existing rules. And so they should assist all divorcing clients, but like with everything, timing is still an important consideration. So if we move on to the next slide. I'll do a quick recap of some of the points which we did touch on last time. So married couples and civil partners can transfer chargeable assets, so property shares or business interests, for example, between them while they're married without incurring capital gains tax. And that's under the nil gain, nil loss rules, where the recipient basically receives the base cost of those assets. But the current rules only allow a couple to benefit from this treatment until the end of the tax year in which permanent separation occurs. So for example, if a couple separated in January 2022 and it was clear that it was going to be permanent, they could only transfer assets without negative tax consequences up until the 5th of April 2022. So it does really matter where in a tax year your separation occurs. After the end of that tax year, transfers of property and assets can often give rise to unwelcome capital gains tax charges, because then deemed disposal proceeds have to be brought into account, which are the market value of the asset in any following tax years. Now, as I say, the changes are very welcome and they improve the situation for a number of people, and they will allow divorcing couples longer to arrange their tax affairs. And from the 6th of April next year, couples will have a much more generous window of up to 3 tax years from the end of the year in which they separate to transfer assets on the nil gain, nil loss basis. And also, it mentions there'll be an unlimited period if the transfer is made as part of a formal divorce agreement. So there have been some legislation issued, and there's been, as I say, a paper that covers off the key points of this. And we'll just have to see if there's any changes before it's enacted in April next year. But these are the key changes. So as I've said, up to 3 years after the year of separation, to make nil gain, nil loss transfers of assets, and an unlimited time if it's happening as part of a formal divorce agreement. As well as those things, there are positives where a home is being transferred. So spouses or civil partners who retain an interest in the former matrimonial home will have the option to claim principal private residence relief when it's sold. And individuals who have transferred their interest in the former home to their ex-spouse or civil partner and are later entitled to receive a percentage of the proceeds when that home is eventually sold will be able to apply the same tax treatment to the later proceeds as applied when they transferred the original interest in their home to their ex-spouse or civil partner. So really, it's very much improving the position for the member of the couple who has moved out of the matrimonial home. So there are some very helpful outcomes here. It gives valuable time to organise the financial affairs without having to focus on the unwelcome capital gains. The main asset is the home, because it will potentially extend the amount of principal private residence relief available to the departing spouse. And it will help put that departing spouse in the same position tax-wise as if they had not moved out. And it will help to even up the tax position on a shared residence for a divorcing couple. And often these are things that take up quite a bit of time to discuss as part of the divorce arrangements. It should be easier to transfer assets without the risk of a dry tax charge, because we're not having to impose market value at as early a stage. So it should also remove the complexities around establishing what the date of disposal should be, because we're not rushing to try and get these things sorted before the end of the tax year in which a couple separates, for example. And it could also remove the complications of whether capital gains tax holdover relief is available on the transfer of assets after the year of permanent separation, which is something that I touched on in the last presentation, so won't repeat here. Unfortunately, because these rules are only coming into effect from the 6th of April next year, not all couples will actually benefit from these. So I just thought I'd go through a few examples to bring this to life for you. So those couples where separation arises in the current tax year should benefit immediately from these rules, because transfers before the 5th of April 2023 are already within the nil gain, nil loss rules, because this is the tax year of permanent separation. And the new extended period would then apply to transfers made on or after the 6th of April next year. Unfortunately, those who have separated before the 6th of April 2022 will only benefit if they're prepared or they're able to defer the transfer of their assets until a time after the 6th of April 2023. And that brings into question as to whether that's appropriate to the negotiations that are going at the moment, or whether it's even possible. Those who divorced a few years ago will only benefit if the transfers are made after the 6th of April 2023 as part of formal arrangements which have not already been concluded. And obviously, when they were making their arrangements, they had no idea that these rules were going to come in and be relaxed. Just as a reminder, these proposed rules don't extend to income tax. And so any dividends or bonuses, for example, that might be taken from a family company to fund the divorce settlement would still trigger tax liabilities. And just for clarification, it does only help couples separating following the breakdown of a marriage or civil partnership. Couples who haven't had that marriage or civil partnership and are just living together won't have access to these rules, and they never have. So there are some complexities that do still remain. Obviously, it's a positive step, but they do still need to consider the tax consequences of their proposed financial settlement. Capital gains tax could still arise, for example, if cash is required as part of the separation. So if they're disposing of assets to third parties, the usual capital gains tax rules would still apply, or where they're finding it difficult to agree the future ownership of an asset and therefore need to get rid of it. These rules apply to the UK. So if a couple has overseas assets, they could still trigger tax issues in those local jurisdictions. And so tax could still be due on the transfer of an asset between a couple, and there could be a mismatch between the taxes that are arising. The extension of these rules is positive, but it does mean that it's unlikely that they'd be able to benefit from other capital gains tax release, which they might have been looking towards. So for example, the use of capital losses and business asset disposal relief against the deemed gain that could have been used had market value been used. And also the recipient in this scenario is receiving the asset at their original acquisition value, and that value could relate to a number of years ago. And so in the future, when they dispose of the asset, it could trigger a significant tax charge at that point in time. So it is something that needs to be considered when you're looking at what the implications are for each party. So there are still steps that we'll need to assist with, and detailed planning should still be included. So when considering the financial order and the split of assets between a separating couple, it will still be important to consider the tax position, and tax could still reduce the total value of the assets that are available to be divided between the parties, but should help simplify the process. And as I've said, it is necessary now to look more at the base cost of the assets, which each party will end up with, because on a future sale, even if the market values of those assets look the same now, one party to the marriage could have a much larger capital gains tax liability than the other one, because it will all link into what their base cost is that they receive. So hopefully that was a useful flag up that there are some changes hopefully coming into play from the 6th of April next year that will assist divorcing couples. But I did just want to touch on a couple of other things in this section as well. So one of the things I wanted to mention was just not to forget the trust registration service. I'm sure a number of you, like us, we're dealing with a number of entries onto the trust register due to the changes that have come in from the 1st of September, which means that far more trusts need to be on that register now than before. And again, these are things that we've touched on in the past in these sessions. Don't forget that there are still ongoing requirements for this trust register. So be that there's taxable trusts on there that need to make annual declarations, or they're non-taxable trusts where you've got new ones that need to be entered onto the register. And just as a reminder that if any of the information on the trust, for example, the people connected with it, like the trustees or the beneficiaries change, then changes should be notified to HMRC to update the trust register details within 90 days of those changes. There were also some changes over the summer to the guidance on the trust register in the trust register manual, and they are reasonably technical in detail. And although we can't go into them in a lot of detail in this session, I did just want to flag them up to you. So as a reminder, the trust register isn't just the trusts as we think about it that are on there. It's primarily there to catch situations and make sure that HMRC are meeting their anti-money laundering obligations. So it's concerned with assets that are not owned by all the owners, as commonly happens. So it's concerned with looking at where ownership of an asset isn't the same as the beneficial interest. And so that can catch other scenarios as well, like bare trust situations and also partnerships. As I mentioned, there'd been several technical updates over the summer. For example, I think it was the 20th of July, where they updated the guidance on partnerships. And on the 2nd of August, there were some updates on when estates and trusts connected with wills and deeds of variations are caught, and giving various different examples. The guidance is reasonably technical. It would need some reading, but it does raise issues for partners and advisors on how partnership properties are owned and what scenarios would mean that those actually need to be recorded on the trust register as well. And for estates, there are various different things to consider about when situations need to go on that trust register as well. It's clarified that there are situations that may be different from the initial interpretation, particularly where deeds of variation are forming part of an estate and how assets are passing to beneficiaries. So whether it's within the initial 2 years since death, whether assets are being appropriated, whether they're being held as bare trusts or not. As I say, some of this is very technical. I'd suggest that if it's coming as a surprise to you, you have a look at some of the commentaries on this and look at the trust register manual, because it can depend on the exact circumstances as to what needs to go on and whether any exemptions apply. Now, finally, as we've put on here, this last slide has been affected by the recent change in TAC from the mini budget that we had. So as we've said, the 45% rate is still going to continue. So that will still apply to trusts. But obviously, because there is this reduction in the dividend rates, removing the national insurance increase, that does have some implications for trustees going forwards as well. I hope that's been helpful. If there's any questions, feel free to put them in the questions and answers box. Otherwise, I'll pass you over to Paul to do his section on tax investigations and inquiries. Thank you.
Thank you, Vicky. Good afternoon, everybody. For this final portion of our tax update for professionals, this session, what I'd like to do in my coverage of tax investigations and inquiries is really look now at the very wide-ranging nature of HMRC's current, what they call compliance activity. They refer to it more and more as such. In our speak, it's tax investigations, it's tax inquiries. What HMRC are looking for now is current compliance, or rather a probable lack of compliance. And the issues arising not only as to the tax, but resultant penalties, for example, as well. The first area that I'm going to highlight for you is a very simple and straightforward one, but it shows you just how keen HMRC continue to be in particular sectors of the economy. This is a very recent initiative as regards looking at taxi drivers. What they have done is to obtain data from the taxi booking apps. Quite how they've got that, to what extent they've got that, isn't clear. But this is the source of the data that they now hold. And as a consequence, they are writing out to various drivers who HMRC think may have underdeclared income for tax purposes or may not have declared it at all. And the letter goes on to say that there is the opportunity to make to HMRC a voluntary disclosure. It will be voluntary to the extent that HMRC will receive it, but they will receive it on a prompted rather than on an unprompted basis. So that in turn will affect the rate of penalty that will almost certainly apply in the case, if indeed there is any tax that is as a result. But they are inviting the driver to sign and return a certificate of their tax position. And they would like that within 30 days. What does a client or a potential client do on receipt of that letter? They shouldn't ignore it, because if they do, the likelihood is that it will invite some form of inquiry rather than the invitation to make a disclosure. So there is an obligation really to make some form of a response. But as regards the certificate that they ask to be signed, there is no legal obligation for that to be signed and returned. Those certificates actually are very widely drafted. They don't have a start and end date, and they don't have any de minimis. So it's quite an obligation to put on somebody to say they have never underdeclared any of their taxes. So the advice would be steer away from really signing this certificate. However, if there is a disclosure to be made, then in all likelihood, do it by way of a letter. It's interesting that as regards obtaining a license to operate a taxi, the authorities require confirmation that the tax position is clear, and they won't renew that license without that check. So you can see now this is becoming more and more joined up in the way that the tax system is operating in particular sectors, and this being a very straightforward example. This is a very different one, but it illustrates again just how wide HMRC's activity, tax inquiries and investigations is. There is a bank over in Puerto Rico in Central America that goes under the name of Euro Pacific International. And HMRC has become aware very recently of a number of UK individuals who have or have had an account with Euro Pacific International Bank. And 600 of those people are in the process of receiving letters from HMRC. We've actually seen a couple of these letters, and they're very widely drafted. It looks to me as though HMRC have received 600 individuals' names on a schedule. They've drafted a template of a letter, and they've mail merged the two. Because what the letter basically says is that HMRC have become aware that the individual may hold either individually or via some corporate structure an account with Euro Pacific Bank, and they may not similarly have fully complied with the UK tax requirements. Now, this is all part of what HMRC call their no safe haven strategy. HMRC in the UK are part of the Joint Chiefs of Global Tax Enforcement, known as J5. J5 comprises the UK, the US, Canada, Australia, and the Netherlands. And what J5 is doing is, in conjunction with the Puerto Rican authorities, is following on from the authorities in Puerto Rico's own inquiry and investigation into this bank, coming at it from suspected tax evasion and money laundering. It was a 2-year inquiry period that the authorities in Puerto Rico looked at this bank. They were so concerned by it, they closed it down basically earlier this year. And as a consequence of that, this information then became available to the J5 countries, the UK being one. Hence now HMRC having this data that they are now writing out for. What does Euro-Pacific Bank International do, or what did it do? It provided bank accounts basically for individuals and SME size corporates on a very, very confidential and low-key private basis. And not surprisingly, it will have attracted people with funds who perhaps wanted to keep their affairs well out of, for example, the UK tax authorities. Now, what had frustrated the UK, as other authorities around the world, is that Puerto Rico as a country was one of the few jurisdictions that did not adopt the Common Reporting Standard. Now, the Common Reporting Standard came in 2018, and it includes about 100 countries around the world who are basically signed up to providing annual information. So, for example, from the UK's perspective, every year the UK tax authorities will receive substantial amounts of data from tax authorities around the world, previous to which they have never had. Puerto Rico fell outside that facility. So what this now does is give HMRC yet further information on accounts held in Puerto Rico by UK resident individuals. This, I suspect, is going to be a very detailed and lengthy investigation. HMRC are not only opening civil investigations, which are the types that we typically deal with, where we are looking at monetary settlements in one form or another, or alternatively, they will wish to make an example of certain people and launch criminal investigations and prosecutions resulting. HMRC don't like Euro-Pacific International Bank. Euro-Pacific International Bank started life in the Grenadines and St. Vincent in 2011, I think it was, and some years later went to Puerto Rico for their own reasons. But because they've been off HMRC's radar, now they have this information, they will pursue these cases very, very significantly. I mentioned that we have seen a couple, actually, very low level amounts involved from what I can see, but I don't think that is typically what HMRC will feel the remainder of the cases will give rise to. If a disclosure has to be made to HMRC by a UK individual to, if you like, regularize their tax affairs, then there are typically two ways to do it. One is to go through a facility known as the Worldwide Disclosure Facility, being that it's an overseas item that is now being disclosed in that. The idea here, though, is that you would have to be very careful in choosing that, because you would want to demonstrate that it was careless activity and behavior by the individual, if you like, rather than it was deliberate or fraudulent activity, because that is where the contractual disclosure facility, otherwise known as HMRC's Code of Practice 9, would apply. And that is where, in return for making a full and prompt disclosure, it's most important that happens, HMRC will agree not to prosecute. Now, these cases plainly have to be handled very, very carefully, and great care is required to decide which facility would be appropriate in that particular situation. Here's another one. This is HMRC inviting wealthy taxpayers for a pre-filing chat, as they call it. This is a little bit naughty, I think, is how the profession sees this activity by HMRC. There's a pilot scheme launched, or was launched back in April, I think it was this year, which invited 1,000 wealthy taxpayers to have a voluntary phone call with HMRC before filing their 21-22 tax return, which is due by the end of next January. Now, this little initiative, pilot scheme it's called, wasn't discussed with the professional bodies. And if one of those recipients has a tax agent, which most of them will have, then the agent wasn't copied into the correspondence. So the feeling of the profession is that it really does risk undermining the relationship between the advisor and the client. When HMRC suddenly surface and say, well, let's have a chat about anything that you may want to talk to us about before you submit your current tax return for filing. The letter says that the phone call that would be held doesn't constitute tax advice, which is ironic when it's coming from HMRC. And it goes on to say that there would be no guarantee that a compliance check won't follow. So you might wonder why any client would take part in this. And the point of me mentioning this is that a number of you will have clients who potentially at least will have this invitation, so to speak. And you may care to raise this as a topic with those clients to forewarn them, basically, and also to make them aware that if they were to get such a contact or call, they may care to let you know straight away as well. Another offshore matter, which HMRC have long wondered how best they can capture this type of information. This is to do with what they call offshore corporates, limited companies based overseas, owning property in the UK. And last month, HMRC launched a campaign to encourage those corporates to what they call check their UK tax position, with a view, inevitably, to disclosing any undeclared tax or underdeclared tax. Where are they getting this information from? Well, typically land registry information linking companies to UK properties. So what HMRC are doing is, now they have that information, is starting to write out to those corporates, inviting them to check, to rectify mistakes in the tax system and to make a proper return as a consequence. It then begs questions such as, well, if there's an overseas corporate involved with owning a UK property, what about connected UK resident individuals of that corporate being involved somehow in the structure, not least from a tax return perspective? So the question then arises as to whether there is any knock-on as to not only the offshore corporates' UK tax requirements, but also individuals, and whether there are any trust structures, limited liability partnerships as part of the structure, all caught, at least potentially, in the UK tax system, or should be. And as a consequence, because it is so wide-ranging, there are two versions of this nudge letter, as HMRC refer to it, dependent on what they may suspect is the type of structure that needs more information to be disclosed on. And just as we saw a moment ago with the Euro-Pacific Bank disclosure situation, here is another situation where if a disclosure is to be made and needs to be made to the UK tax authorities, how should it be done? There's an overseas element, so the worldwide disclosure facility can be appropriate, but again, that would only really be where it was careless behaviour at worst, as opposed to if the structure had been put in place with a view to deliberately evading UK taxes, and thereby fraudulent. The contractual disclosure facility, Code of Practice 9, would be the more relevant route to follow, but it does require, particularly in those cases, great care, because of the requirement to make a full disclosure is so important to avoid a potential, if not real, threat of criminal prosecution. And lastly, the coronavirus job retention scheme compliance activity, I have covered off in previous presentations. As the furlough scheme worked its way through the system, you'll all be familiar and will recall, I'm sure, the fact that the furlough scheme was implemented over an 18-month period from March last year, March 2020, finishing 18 months later at the end of September 21, 12 months ago. And what HMRC are now doing is that they are looking to recover overclaimed furlough scheme payments made. You'll recall that payments were made out very promptly, as was the requirement under the furlough scheme, to support businesses and to retain employees as a consequence. And in so doing, because of the way the rules were drawn and they varied through the furlough period as different criteria applied at different stages of the claim process, that it was quite difficult actually for businesses to fully comply, even though they were doing their best. So a number of businesses will have made errors. They'll have done their best, but they will have made errors in the cold light of day. Additionally, there are those that claimed it fraudulently. It is said now that when they boil all the cost of furlough down, it cost the Exchequer 70 billion, of which a not insubstantial percentage they believe should not have been paid out. And not surprisingly, they are directing their attention to increasingly trying to recover it. So the Taxpayer Protection Task Force that they put in place some months ago remains in place for a few more months. And there is already a case that has gone to the first tier tribunal as to how strictly HMRC apply the rules. And what is coming out of that case is that they are applying them very strictly. It's important for employers to remember that they must keep all coronavirus job retention scheme records for 6 years. And if they do receive letters from HMRC raising inquiries as to their claims, that they should act on them, and they should act on them quickly, not just put them to one side. And there we have my presentation.
Thank you, Paul, and thank you, Vicky. I hope everybody found that all of interest there. Plenty of things to think about, and that's for sure. Now we do have questions come in. Oh, hi, Mark. Good to hear from you. Just want to check. No change to tax on dividends at 7.5%, even though there's a reduction to the 1% reduction. That's correct. Yeah. So even though the basic rate is being reduced to 19%. The basic rate tax on dividends is still 7.5%, so that hasn't changed. Likewise, a £2,000 dividend allowance is still exactly the same as well. So, yeah, dividend rate still 7.5% for basic rate taxpayers. And the only other point I just want to bring up very briefly, just to finish off on, is to do with the deferred tax. Sorry, the corporation tax increase not going ahead. It's to do with deferred tax because at the moment the 25% rate is legislated for. So any deferred tax calculations are being done at 25% at the moment, and will need to be continued to be done at 25%. Until that legislation is repealed, because you can't put a 19% deferred tax provision in until the legislation is substantially enacted, which is probably not likely to be until probably early in the new year. So again, just something to be mindful of there, that deferred tax should still be calculated at 25%. And materially, it might not make a huge amount of difference. But in some cases it might do, and it might warrant a bit of a note on the deferred tax note in the accounts, potentially, just to explain the changes. Right, well, thank you all for listening. I hope you all got something out of that, and we all look forward to seeing you in a few months' time. Thank you, everybody. Goodbye.